Hey everyone, it's Juan Weezar with Sage Real Estate. In today's video, I'm going to cover cap rates, which is capitalization rates. What does it mean? Why is it used? How to calculate it? My goal by the end of the video is you are able to take what I've given you and put it to use immediately. So whether you're trying to price out a property, maybe your parents are thinking about selling their 8-unit building and you're like, let me try to help a little bit here, do some of the work. That's gonna be the goal. I'm gonna do a deep dive. This will be my second video on this and you are definitely gonna understand. So let's get right into it. If you're in the world of real estate investments, you're gonna hear one term, which is the most popular term out there, and it's capitalization rate. They chop it down, they shorten it down to cap rate. So oftentimes you'll hear, hey, we're looking at this 8-unit building, and an investor's gonna say, great, what's the cap rate? Okay, and so I'm gonna try to like demystify what cap rate is. I think a lot of us make it seem too big of a deal. I know that there's a lot of realtor friends out there that watch our channel. They mainly sell single family homes and sometimes they're like afraid of this cap rate. Today's video, I'm gonna make sure you're not afraid of it so that you like understand it. And then you realize, oh, there's just really 3 components to it. Here's what it means. And we could play around with those 3 components to come up with different values, okay? And so the first thing is, if someone says, what's the cap rate? Essentially what they're saying is, what's the rate of return based on the net operating income and the valuation? There's 3 important things when we're talking cap rates, and I'm gonna jot that down for you. The first one is net operating income, okay? This is really important. And we shorten this down and we call it NOI, okay? So that's gonna be the very first thing, and I'm gonna tell you how we arrive at this. Now down at the bottom, there's cap rate and there's value. When we're looking at a piece of real estate, an income producing property, we're gonna take all of its income that it brings in. So if it's an 8-unit building, heck, if it's an office building, it doesn't matter what it is. If something's bringing in income, we could figure out, okay, here's the income. What are the expenses? And so I'm going to go through that in detail, but those are the operational expenses. What is an operational expense? So let's just say that I own a 8-unit building and I decide to sell it to you. The operational expenses are the expenses that I needed to incur to run this property. And so last time I gave you kind of a quick summary where I called it trim up. And it was just like, I have taxes, you're gonna have taxes. I have insurance, you're gonna have insurance. I have maintenance cost, you're gonna have maintenance cost. And so we kind of go back and forth, property management, you're gonna have property management. And it's essentially saying what expenses, no matter who buys the building, this building is gonna incur these expenses 9 out of 10 times. Every single time you're gonna have these expenses. Now, if you remember from my first video, it's critically important, we never plug in mortgage into this component, okay? And so going back to net operating income, before net operating income, we actually start with gross income. Here is where I see a lot of people make a mistake, is that they take the gross income, they divide it by cap rate, and again, cap rate is the rate of return that you expect to get on a 12-month period, okay? And I'm gonna explain that a little more too. The mistake that I see is people take the gross income, all the income that this property makes, again, not in 1 month, in 12 months, because it's a 12-month snapshot, okay? Gross income divided by cap rate gives you valuation. So that's not the way to do it, okay? So what we need to do is we start with gross income, and we need to deduct the operational expenses to end up at NOI, because again, this is our calculation. I called it Uncle Irv. I still call it Uncle Irv, and it just looks like this. And any of you watching this could do this at home right after this video, because you don't need anything special. You don't even need a special calculator. Your phone calculator could determine this. So at any time, if someone calls me and says, we just inherited an 8-unit building, I'll say, great, give me your rents. They give me all their rents. I quickly add them up on my calculator. Most times I'll say, can we go through your insurance? Can we go through any maintenance costs, your property management, utility cost? Because what am I trying to get to? I'm trying to figure operating costs, right? So operational cost, okay? Now, most times I could estimate that. In my prior video from a few years ago, I said that it's a good rule of thumb to be at 30% operational expenses. That has since changed, and I'll tell you why. A lot of costs have gone up. And so now the rule of thumb is going to be 35%. In some cases, it could be as high as 40%, depending on the building. And so now I no longer use 30%. I use 35%. And a lot had to do with the insurance cost. In some cases have been doubling or more, and that's changing my operational expense. So going back to this, you could go find any income producing property, take its annual income, deduct its operational cost, and some of you might say, where do I find the operational cost? Any building that's being sold, the listing broker most times will have what's known as an OM, an offering memorandum, okay? And in there, they'll give you all the operational costs. In fact, they'll do this math for you. They'll get into the net operating income. And typically what you do is you divide, well, you could do two things. You could divide by cap rate if you know what your desired cap rate is, and it's going to give you value, okay? Or if you know the net operating income and you know the sales price, you do this division, it's going to give you the cap rate, okay? So long as you have 2 out of the 3, you have enough information. Now, let me give you a few warnings out there. I do not use cap rate for several things. I don't use them for single family homes, although you can come up with it. I don't use it for condos. And quite frankly, if you're selling a duplex, a triplex, or even a fourplex, you could come up with the cap rate and you could use the cap rate to come up with valuation, but I'm gonna warn you that the market might not be looking at it like that. What does that mean? There's 2 things that needs to happen. We have the market inputs into the financial inputs. And so I need the market to tell me how it prices certain types of investment assets. And a house is typically not bought for investment purposes. And so although I'm telling you, like sometimes people will call me and say, hey, what's the cap rate on that condo? I'm like, you gotta be kidding me. Like we don't sell a condo under that premise of cap rate. Doesn't mean that you can't put it on it. It's just, it's not as applicable. And because we do sell a lot of 4-unit buildings, all of them we could say, what's the gross income? What's the operational expense? Give me the NOI. What did it sell for? We have a cap rate. That's how I just work down this system. So it's pretty simple. Could I do that for every fourplex? Yes. But here's what I want you to understand. 9 out of 10 times when I sell a 4-unit building to an investor, they don't know what cap rate is. They don't know what it stands for. They don't really care. They don't put a lot of weight on it. So cap rate is one metric out of, say, 5 metrics, okay? And it's an important metric. People, in my opinion, give it way too much emphasis. I think that there's other metrics that could work well. So it's a very important metric, but it's not the end-all be-all, okay? And in some cases, someone buying a fourplex because they have some money that they've saved up, 25% down on a fourplex, and they like its location, they like the income that it's bringing in, they're not always asking me, Juan, what's the cap rate, right? But once I get into larger buildings, anything 5 or above, it becomes more prevalent, okay? Okay, so here's a little cap rate case study, okay? So here's a little homework that I want you to go do. And if you go do this, tell me how it goes, and I want you to come back and send me a comment, leave a comment below. Okay, go find a 5, 6, 7, 8, 10-unit building, okay? Let's not make it too big, it's gonna be too much calculating, but let's keep it a little simple. So here I have an 8-unit building, I have 8 rents, okay? These are per month rents, we add them up. Any of you could do that. Again, we don't need a special calculator. And this is my monthly income, $11,600. Okay, this is like everyday scenario. People call me and say, hey, I have this building. And I'm like, great, what are your rents? Because here's what I want you to know. When someone's buying your building, Here's how I want you to start thinking. I no longer believe they're buying the physical asset. They're really buying the income stream. And so what they really want is a property that brings in a much higher income, right? And so that's one way to look at it, okay? So here we have the monthly income, but I told you earlier in the video that we need the gross annual income. Okay, so this monthly income, multiply it times 12, you could do that, gives me a total of $139,200 for the year. So that's my gross annual. I did tell you that we need to subtract the operational expenses. Now, if the building you're looking at, or if you own a building, let's look at your operating expenses. What expenses run with the building no matter who owns it? That's the way to look at it. Okay, you could include the gardener bill. You could include, there's going to be a new property tax bill in most cases, insurance cost, typical maintenance, not like I added a new roof last year. It really, my operational expenses are higher, Juan. No, that's a capital expense. We're not going to like ding 1 year heavily on that, okay? So it's just the basic stuff. Property management. Maybe you pay the water bill. That's the kind of stuff I want you to include, okay? Again, no mortgage, okay? Let's be very clear, no mortgage. So in this case, I applied a norm 35% operational expenses, okay? I subtract that because if I buy this building, I'm gonna have property taxes, insurance, and those are my big ones, okay? So I subtract that, I come up with my net operating income NOI. That's, if you remember, that's one of the things that you're gonna need to plug into our IRV formula. Some of you asked, why do you call it IRV? It's just a simple way for me to remember, but it's IRV, so IRV. I call it Uncle IRV. I don't know, I guess I could have called it Auntie-IRV, but Uncle IRV sounds right. So I now take the net operating income and NOI, it becomes the I, okay? So this is really what this means, NOI. Now, I'm gonna show you guys something. I'm gonna divide by cap rate. And in this scenario, if I was an investor in a certain market, let's just say Southern California, and let's just say Long Beach. If I'm an investor and I'm like, I want a 5% rate of return, that's essentially what you're saying. It's essentially what cap rate means. And not to confuse you folks, but let me just give you an example. If you were to buy a building cash, so no financing involved, the cap rate would be your rate of return, okay? So that's one way to look at it. So if I'm an investor and if I'm like, I'm accepting of a 5% cap so long, so long as it's in Belmont Shore, Belmont Heights, Naples area of Long Beach, meaning like I want to be in a certain area and I will pay 5%. So if someone tells me that, I'll say, okay, then you would probably pay $1,809,600, pretty much 1.8 million for the building, okay? That's what you would tell me. Now, if that same investor says, Juan, man, the cap rates have been going up, and again, I'm using Long Beach as an example. I recently did a presentation in front of a lot of appraisers, and what I did is I went back 12 months in Long Beach. The average cap rate was 5.3, okay? So knowing that, some of my clients might say, hey, Juan, I heard your presentation. I don't want to pay, I want a higher rate of return. So then I would say, oh, okay, I get it. You don't want to overpay for the property. The market is selling and trading at a 5.3 cap. So you'd probably be comfortable with a 5.5, 5.3 or 5.5, okay? If you did that, then the value would be $1,645,000. So what happened here? The value went down. Okay, the value goes down and the cap rate essentially had gone up, okay? So here's what I want you to know. There's an inverse relationship going on. If you, as the buyer, want a higher rate of return, it's going to punish the value. It's going to bring the value down, okay? And so all of a sudden, if you're accepting of a 5.5 cap rate, you're now going to offer this amount. This would be the price that you could come up with and say, this is how we've arrived at value, $1,645,000. Someone could call me and say, how'd you pick that number? oh, well, the market is trading at a 5.3 cap. We're going to offer you 5.5, okay? And I'm going to take it one step further. Let's just say that right now, I'm going to tell you guys this. In most apartment markets, and now I'm speaking on the what we call the commercial stuff, so the 5 units and above, the cap rates have been going up. So the cap rates have been going up, so that should tell you that values are going down, okay? Because cap rate goes up, value goes down, okay? It's an inverse relationship. So if you're an investor, this is exactly what you want to hear, okay? Hey, Juan, you just said cap rates are going up, and they've been going up for the last 18, 20 months. Values are coming down then, Juan. 100% true. Juan, is it a buyer's market or a seller's market? It's a buyer's market. It's a buyer's market in the 5+ space. It's a buyer's market in the 5+ space. It may not be a buyer's market in the 3-unit, 4-unit space. It could, depends on where you're at. It's definitely not a buyer's market if you're looking at single family homes. That's a seller's market. So it's very important that we don't lump all these very niche products of real estate into one umbrella of real estate is doing this. That's not the case. So if someone says, now this would be a very smart buyer would tell me this. Juan, your last presentation, you said Long Beach is trading at a 5.3 cap. Okay. You also said that you expect cap rates to continue going up. I did say that. So you're saying that values are going to continue dropping. Correct, they are. So someone who wants to buy right now, they have money, they're an investor, they don't want it sitting in the bank. They might say, well, I'll buy that building. I'll buy this 8-unit building. I'll buy this income stream. I'll buy it, but I want a 6 cap. So what does that do again? Drives the value down even further. $1.5 million, okay, significant drop. I mean, we're looking at about $145,000 more or less in difference in price. This is how investors play the game of real estate, is that they're working with the numbers because it's a direct translation to value. And so oftentimes, a property hits the market, it might be at a 5% cap, and they might want 1.8. They might get it, they may not. And if our offer comes through and it comes in at significantly lower, over $300,000 lower, they might be offended. Or I can simply call the agent or the seller and say, hey, given all the market data that's happening, given all the recent sales, given the fact that we expect the market to continue to be soft, we're glad to buy the property, but now at this specific price, which we used cap rate to get us there. One thing that I did not mention in my last video when I did this, the same is true for value. Let's just say that you didn't know the cap rate, but you knew the different prices. I take the NOI, I divide it by 1.8, it's going to give me the 5%. I take the NOI, I divide it by 1.5, it gives me the cap rate. So oftentimes I'm going back and forth. And sellers call me all the time. We'll sit down, I bring out my calculator, I come up with the gross income, we come up with the operating expenses, and then this is where we have the deep conversation. Most sellers have a value in mind. Juan, I want $1.8 million. Okay, let me plug this into Uncle Irv. I know the NOI. You want $1.8 million, so I take the NOI, divide by the $1.8 million because that is what you want as a seller. Now I'm at a 5 cap. Now me as a broker, I'm having to look at this and say, ooh, 5 cap, but we're nowhere near the beach. Meaning like location plays a role. And so let me get into that next because on the first video, a lot of folks reached out, commented, I appreciate you guys all, but the question was like, well, where do I find the cap rate? How do I know the cap rate in my area? And that's market derived. And so I don't care what state you're in, what city you're in. And if you're comparing an 8-unit building like this, what you need to do as an investor, as a broker, as an appraiser, you got to go find similar 8-unit buildings in the city. You have to. Okay? Go back a year and say, other similar 8-unit buildings what was their income, what did it sell for, use Uncle Irv and come up with a cap rate and make a note of it. And come up with as many cap rates as possible. Now, sometimes there may not be a lot of sales. If you come up with 3 cap rates, it's going to give you a range. Now you could use that cap rate to apply into the calculations. Because some of you who are out of state, you might be laughing at me like, I can't believe that in California, you're going to settle for something as low as 5 to 5.5% cap, because that is way too low in your opinion. So let me make this very clear. In most cases, if you're a buyer, you want a higher cap rate because that's a higher rate of return. If you're a buyer, if you're a seller, you do not want to hear. You want to cover your ears as you're watching this video when I'm saying cap rates are going to go up. Because if you're a seller, what do you want? You want a lower cap rate. Heck, you want a cap rate in the 4s. You want a cap rate in the 3s, okay? Because that inverse relationship is going to shoot your value up by hundreds of thousands of dollars. And so it just kind of all depends. Now, at the end of the day, I don't care what the buyer wants. I don't care what the seller wants. Because that's not what I'm trying to do. I'm trying to justify value. I'm trying to justify value by what market trends have given me. Again, in Long Beach, we're at 5.3% as of today. That's the cap rate. Now, we could break that down a little further, because it could be that in areas that are less desirable in Long Beach, maybe the cap rates are 5.75, 5.85, 6. And it could be that if I get closer to the beach that we start driving that down. But I'm just saying average overall, we're at 5.3. It could be that in Texas or Illinois, Michigan, it could be that cap rates are 8, 8.5%, which would be a higher return. Now, it's not to say that a low cap rate is a bad investment play, because I want you to know the difference between high cap rates, low cap rates. Typically, if I see a property with a very low cap rate, it tells me a couple things. The location must be superior, must be so dang nice. I'm talking like, I don't know, Newport Beach, near the beach, Manhattan Beach, near the beach. Like, that is a great property located in one of the best areas. And so what ends up happening is, when we're looking at cap rates, you could assume, in most cases, the lower the cap rate, the less risk, perceived risk. Why is there less risk? Well, an investor is going to say, you know what? I'll settle for a lower rate of return because I believe it's going to be easier to own and manage that property. There's going to be tons of, like, I may not have high vacancy rates in an area by the beach because we would assume that you could quickly rent those out. And so it's not to say that, hey, I watched that video that Juan made and he said low cap rate means high price, so avoid it. I'm not saying that. I'm saying, what is it that you're in the market for? Because we do have a lot of investors who sometimes will say, hey, Juan, I want a property that is a trophy property and it's turnkey. So that's industry jargon for everything's been renovated, it's been painted, the rents are good, they're high. In those types of cases, that type of property is going to sell for a lower cap rate. On the flip side, we have a property that's an 8-unit building. 4 of the tenants have stopped paying rent. The city has citations on the property. Well, I'll tell you what, that is going to be much higher risk. So what does an investor say? With higher risk, I want a higher cap rate. Now, cap rates are great, and I want you to understand them. I want you to use them. There is a few limitations. So here's the first one. The first limitation is the operational expense. In the prior example, I told you that I estimated it to be 35%. Sometimes a seller will sell a property and they may not necessarily want to show you all their expenses, right? Because then that helps their NOI, which then ends up giving them a better value. And so that's one of the limitations, is that we have to believe and trust that the seller is telling us the actual expenses. We have to believe and trust the real estate broker who's in the position of they have to make this property look as best financially, because remember, you're buying the income stream of the property. Now, really quick, this exact example is going to work for an office building, an industrial building. It's going to work for a retail center because it has income. And you just have to know what is the standard operational expenses that you should apply to it. And more importantly, so once you know that, with that type of asset type, that type of building, where do investors currently pay from a cap rate perspective for that property? So that's some of your homework. So I know some of you guys are going to be like, hey, I'm in Michigan, what's the cap rate here? I'm not going to know it because I don't work there. But you should do your homework and you could figure it out. If you're working with a real estate professional, hey, that's one way to weed some. If you're looking to buy some units now and they're like 5+, 4-unit, 5+ or more, and you're working with somebody, ask them, hey, what's the cap rate now? And is it up or down? What was it 12 months ago? And where do you believe it's going to go? If they could look you in the eye and know the answers off the top of their head, that's someone who knows what they're talking about. If they twiddle their thumbs and they're like, yeah, let me get back to you. Anyone who says, let me get back to you, head for the hills, go hire somebody else. They are not a professional. If you're in this business, you know exactly where these numbers are trading. You have to know it because that's how you're valuing properties. If you're really in this business as a professional, you're working with buyers and sellers all the time, and this is one of the metrics that we're constantly, every single time looking at. So that's just a tidbit of information. Now, some other places where the cap rate is not as great. Earlier in the video, I told you that the cap rate is a 12-month snapshot. So if you're buying this 8-unit building and everyone agrees that this of the price of 1.5 and a 6% cap rate, great. That, again, is just a 12-month snapshot. So it's not the cap rate for the next 20 years. It's not. And so we have to know, when you're an investor, there's 2 things you want to do, okay? Every single time, every investor, every buyer wants to do this. And so if you're going to be a buyer, you're going to want to do this too. You're going to want to increase the gross income. You want this number to go up. You want to figure out how can I make these buildings better so that the rents go up. So that's number 1. Everyone is going to want to do that. Then what's the second thing? You want to lower your operational expenses. Every single time, that's what you want to do. And it could have been that the person you're buying it from, maybe they weren't managing it right. Maybe they were letting their expenses run a little higher than they should. And so your job is, I'm going to raise the rents and I'm going to pull down the expenses. That's business 101. And that's the exact same thing. Now, when you do that, on the 13th month or every single year following, you're now changing the cap rate. So you may have initially bought in at a 6% cap rate. It's not to say that it's going to stay there forever. It's not to say that you're not going to adjust the rents and manage it better than the last person. You could certainly improve it. And so those are one of the things, because sometimes you might look at a building where the cap rate is not acceptable to you. And that's okay, but maybe you like the building for other reasons. It's got potential, the location. The rents are super low, but you know that little by little you could get the rents up to market. The cap rate is not the end all be all. It's one of 5 measurements. I did do a video where I went through all 5. And what I do, when I'm looking to buy a building, here's what I want to do. Here's how we got to think of things. The market sells at a 5% cap. So let me do this, okay? And we're able to buy at a 5.5. Why does that matter? Because the difference is your equity. So I always try to beat the market. But in order to beat the market, you have to know the market. But if you're watching these videos, if you've been following me, you have to invest in yourself. You have to invest in the area that you want to be in. Because if you know the market, you're like, man, everything trades at 5, Juan. Every single 8-unit building in this area trades at 5. I got it at 5.5. I'm like, holy smokes, you just made money. Day one. Thousands, hundreds of thousands of dollars. You did it because you knew the market better than someone else, okay? And so, again, in summary, there's 3 things that we need. We need to know the net operating income, and we either need to know the value that you're willing to pay or the value that you want for your property, and it's going to give you the cap rate. If you don't know the value, but you know the cap rate, it's going to give you the value. So actually, off of those 3 things, you only need 2. And with that, I'm going to wrap up. I hope you enjoyed this video. For those of you who are gonna actually take my advice and go do their own case study, go take their own building, let me know what kind of cap rate you're getting. It'd be surprising to see what's out there. Until next time.